Yes, brother.
Yes,
How are you? How are you?
I'm fine, thank you. You can hear me, right?
Yeah, I can hear you. Let me see.
Okay.
Yeah, I'm already recording now. We are going to start from the first topic. I will discuss slowly by slowly so that I can create some awareness of what
Okay.
you know, what you don't know. So definitely our first topic is a trend. Our first topic is a trend.
hmm
So what do you know about a trend?
Okay. You mean the trading itself or
I mean trend,
the
trend, trend,
trend,
trend.
how the market is moving?
Market is moving.
Hello?
I said, what do you know about the trend of the market? The trend.
Yes,
Because it's our first topic, trend.
I understand.
Hmm?
I understand it like the when the market makes highs and lows or lows and highs in case of a downtrend and an uptrend.
Okay, now, first of all, we have
Yes.
four kinds of trend. We have four kinds of trend. And the first trend, um, we have four kinds of trend. We have four kinds of trend. So we have the bullish trend,
Yes.
have the bullish, we have the bearish trend. We also have uh the ranging, the ranging, and also have the stagnant price action. A stagnant trend. Let me just call it a trend. It's called a stagnant trend. So this is how the bullish trend looks. We know that price is only forming highs, lows on a bullish trend. And now we know when price is in bearish, is forming the opposite of this one, which is a bearish trend. Price is always forming a bearish trend. So what is the ranging market? The ranging market is where price ranging, forming equal highs and lows, equal highs and lows, equal highs and lows, equal highs and lows. The reason why it's called ranging because now this is a situation, or this is where we have the equalism between the buyers and the sellers. Buyers and the sellers are equal. That's why it's called the ranging, forming equal highs and lows. Okay? Buyers buyers buying from these support
Yes.
levels, while sellers selling from this resistance levels. So this equalism between the buyers. But on a bullish scenario, we can clearly see that now buyers are more in the market more than the sellers. That's why price keeps on forming highs because the buyers are more in the market than the sellers. And here on the bearish market, now see sellers are more than the buyers because price performs lower highs and lower lows. So the reason why price performs these pullbacks back to these areas of liquidity is price to come and balance the market between the buyers and the sellers before it continues its way. That's why we always see these pullbacks inside these areas of liquidity. Okay, this one price needs to come and
Yes.
balance the equalism between the buyers and the sellers. So we also have this stagnant price action. Now this is a situation when price doesn't have a clear move. Okay, doesn't have a clear move, doesn't form highs, doesn't form lows. It's just there, stagnantly forming fair price action. So we normally don't trade these structures because of the some kinds of unfair price action because of the stagnant is always giving no clear structure, is always giving no clear direction.
Yeah.
So you can't take an entry here, you can't take an entry here. You can't take an entry here, you can't take an entry here. So we'll be liquidated for nothing because we don't have clear structures uh, for this. Okay, so we definitely have to trade only two kinds of trend. The first one is the bullish trend and the bearish trend. The reason why we have to trade these two trends is just because that we know now price is performing. We know now if price is in a bullish trend forming highs and lows, highs and lows. We know now these are the areas of liquidity. We are left with also. So we know now price needs to come and balance these areas of liquidity to move. Okay, it means that you will be able to see an opportunity coming. Let's assume you have been analyzing like a pair like GBP card. Okay, sorry.
Yes.
Let's assume that you have been analyzing a pair like GBP card. You see now price has been forming highs and and lows, highs and lows, highs and lows. Now you know that if price leaves this as the next area of liquidity, you know now price is going to come to balance the equilibrium between the buyers and the price is going to come to balance the equilibrium between the buyers and the sellers. Okay, so that price can continue moving up. Okay, that's why we prefer trading these two kinds of trade only, because you know the price is going to come to balance the market. And the same too, happen to find yourself in a situation like you happen to find yourself in a situation that having a range market or range switch and look for another pair because you won't get good result from this kind of a trend, because it's somehow confusing. Okay, you won't be getting clear.
Yeah, true.
Their trend. Okay, so always your focus, or always our focus, is going to be on the up and the down trend. So what do you know about the uptrend? What do you know about the bullish market?
The bullish market.
Yeah. What do you know about it?
About bullish market, whereby there's validation of the current trend. That is this, if it's a bullish, that it makes highs and lows, and the high has to be broken by the low.
So when
I think there's swing highs.
when we are on a bullish market, we know now price is going to be forming series of highs and lows. That is a highs. Highs. This is like that. Highs and lows. From what you call the highs and lows. Just reduce from there. Highs and lows. And the other thing you should also note or keep focus on trading the uptrend is that price is also going to be is going to be buying. Buying.
Yes.
So when you're buying the market, you are going to form two types of bullish trend. You are going to form two types of bullish trend because we have two types of bullish trend. First, we have the pure bullish, and also we have the bullish differentiating. Bullish. Okay? Those are the only two kinds of bullish trend we have. So how does a pure bullish look like? A pure bullish look like this. So let's assume that we had a structure like this one. So we know now we have this as our validation point. Or price has broken the structure, this becomes a validation point, and that becomes a validation point. For the pure bullish, that's when price comes and tests this validation point and continue moving up. And continue moving up. That's what we call the pure bullish. The reason why price performs a pure bullish is because we don't have liquidities to consume down here. We don't have liquidity to consume down here. Everything inside this zone is consumed. Everything inside this zone is consumed. So price doesn't need to come inside this area because everything is consumed. But sometimes price also performs a pure bullish because of the uneligible liquidity that has been conveyed. Let's assume that this was our area of liquidity here, or this was our trend here. So price comes this was our validation point, and this became our validation point. Okay? So sometimes price performs a pure bullish because it needs to come and consume this area of liquidity that has been left behind. That has been left behind, so that it can also come and target sales from this area and also come to consume the liquidities that are left here before it continues to move up. So the process when price comes and taps on the validation point is called the pure bullish. Okay, so the process when price comes and consumes or drops inside this area here, Okay, this area of liquidity here is called a bullish different bullish. Reason, price should be coming to consume the unconsumed liquidities that were left inside that area before it continues moving up. Are we together? It's called
Yes, yeah.
the bullish different bullish. Price coming to consume the liquidities left inside that zone. It's called a bullish different bullish. Now, the aim of us trading the bullish market is to take an opportunity to buy, and we should, if you always trading the bullish market, we should always look at the constant time frames so that we can target that big buy. So if you want to be a swing trader, you should always look at the long term. You should always look at the long term trend or long term move. Let me say long term move. If you're trading what? Do you see? Bullish market. So now we know that the price has performed a pure bullish. Reason we don't have unconsumable liquidities, or if sometimes price performs a pure bullish is to target the sales zone left behind and then get the sales from that point and then come to consume the liquidities. The process when price performs or comes inside this area to consume the liquidities is called the bullish different bullish. Okay, so the aim is to buy, but using information free as you know it, we can definitely also take sales from this area and target this area. Yeah. Okay. So the other thing that we should also note about this trend is that when price is always moving, we always mark or always consider the low that led to the break. Remember, as the price is moving, in an uptrend, it always formed a series of the higher highs and the higher lows. So in the process of making the series of higher highs and the higher lows, we know now these are the areas of liquidity left. So we always mark the lows that participated. Always mark the lows that participated with the break, or we always mark the lows that participated with the shifting point. We always mark the lows that participated with the shift point. No matter how price can trend or can consolidate, should always have to consider. Okay, so let's assume that is our uptrend. So we know our price block the structure here. Then our price block the structure there. So when price broke the structure, it performs what we call the break of market structure. I told you when you mark in the break of market structure, when you're breaking the break of market structure here, we have definitely to consider or to look at what we call the structure formation and structure confirmation. Okay? Structure formation, and structure confirmation. So what is the structure formation and what is structure confirmation? So the structure formation is when price comes to break this, to form a break of market structure here. But when price performs a break of market structure, it doesn't close with a wick. It doesn't close with a wick. Price doesn't close with a wick. It doesn't close with a full candle. Rather, it breaks or it closes with a candle. It is a wick. That's what we call a structure formation. Price has formed a structure but not yet fully confirmed. It means that we can't mark this as our break or market structure. Why? The momentum that broke this high was still low. Okay, so we have now to wait for the price to perform what we call the structure confirmation by giving a candle closure above this high. So when price performs a candle closure above that high, it's called a structure confirmation. Okay, it's called a structure confirmation. So it means that we confirm the break market structure here by a structure confirmation, not a structure formation. So when you happen to mark the break market structure, always consider price closing above. So if price performs or has a week, don't mark or don't consider it as a break or market structure because it has formed the structure, but not confirming the structure. The reason why price needs to confirm a structure is we know now price it closes week, there are high chances for price to continue dropping lower because price or the momentum of buyers that came to break this high were low. Okay, we are low. So that's why I will say that price has performed a structure. Okay. Now we know now if we are dealing with an uptrend, we need to see price breaking as highs. We need to see price breaking. Let me just write it. When we're dealing with the uptrend, we need to see price breaking, price breaking previous highs, breaking previous highs with structure confirmation. Structure confirmation, which is a candle, closure. Okay, so it means that if in your market outbreak market structure, you need to see price carry taking out this high, confirm it as a higher high. So this is not going to be a higher high. Reason, it didn't have any high it took. Okay, so you need to mark this uniformly high because this is the high. This high, so this becomes our uniformly high. It means that this have to wait for price to come and break this high. So anything that's the low that participated to the break, what we consider as our new area of interest. So this becomes our formation that we expect price to come inside to take an opportunity. So always take entries on the lows or the highs that participated with either the shift or the break. That's how we take our entries based on those laws, because they are the one participated to the break. So currently this is a newly formed high, because now this high is the one that took out this high. So anything here, these are not break market structures. Don't mark them as break market structures. Don't mark them as break market structure, because they are just there to make us move at the wrong side of the market. You know, when you're trading with these big institutions, they always make us move at the wrong side of the market. So these are not break market structures. These are the formations that we had that participated to the break of market structure, which is, let me assume that this was this one. Okay, so when we have now to take entries from this area, we need to consider liquidity consumption to know which area we are going to use. But these are not break or market. These are not break or market structures. Okay, so what we always consider, we always see price coming to these areas. Mean that price has consumed these areas. That this price came in. Whenever price comes inside this area of liquidity, this one and this one, inside the loan, price has consumed that area. So you can get a price just came and tapped a small bit of this area of liquidity. Mean that we know now price may come to test this. Sorry, you know now price may come to test this area here before it continues moving. Up. So we would have participated, we would have marked this as our area of interest for us to come and test that zone. But sometimes it's not always going to happen. Sometimes we leave this area here and use the next one. Okay, but in most cases we always tend to use this formation that or this row that is participated of the shift. But as I told you, this market is uncertain.
Does this depend on the time frame?
It's going to always come at least this nearest one. Okay, sometimes price may liquidate this one and it comes at this area. Reason, according to the liquidity consumption around this area. You know, when the price comes inside this area here, it means that the price has consumed at least 70% of this area. It means that sometimes there is no need for price to come inside this area. It should definitely come and test this one. But whenever you see price coming inside this, deep down inside this area, it means that the price is coming to test the liquidities or to consume the unconsumed liquidities that were left unconsumed inside that zone. So it should always be able to use that when you're covering liquidity consumption, we shall be able to, when you cover liquidity consumption, we shall be able to understand it more. Shall be able to understand it more. So we always mark the lows that participate in the shift, even if this one is here. This is our break of market structure, the upside. So we have this low here. that participated to the shift to the break or market structure, but price may also tend to come and consume this. Reason according to the liquidity consumption, we did have a lot of liquidity consumption inside this area. We shall look more on liquidity consumption when we shall look more on liquidity consumption. Maybe your network, but mine is fine. Maybe your network, bro, but mine is fine. So good enough.
Okay.
Good enough. The recording is the class is recorded. We shall be able to rewatch. So you should always be careful of those formations. Okay, it's called liquidity. So we always mark the laws that participated today, the formation, but it's not going to be 100% guarantee that price is going to come to that area. No, price may also leave that area and come to test the unconsumed liquidities inside it. Yes, we shall be understanding more when you cover liquidity consumption, reason why price does something like that. We shall be able to understand why price does something like that, because the price may also leave this area, may also leave this area here and comes to test this area. We shall know how to do it. So the other thing to know about the uptrend is that when price is moving an uptrend, market should always form what we call the pure. It should always form what we call the bullish, different bullish, because now we know price will consume liquidities. It's very difficult for price to perform a pure bullish. It should be very difficult. But our main aim is to only look for price to consume the liquidities. And how do we see this? By moving down to lower time frames to see how the liquidities were consumed inside those areas. Okay, so that's what I can talk about the bullish trend. That's what I can talk about the bullish. That's what I can talk about the bullish trend. Yeah, so we can also look at the bearish trend. You know, when price is in a bearish trend, our price tends to form what we call the series of lower highs and the lower lows, lower highs and the lower lows, lower highs and lower lows, lower lows, and lower lows and lower highs and lower lows. Reason why price is breaking is forming lower lows and high. Reason price is dropping lower, meaning that our main aim is to sell this market. Our main aim is to sell the market. So whenever price forms a break on market structure, these are the areas of liquidity that are left. So price needs to come and retest those areas before it continues to move down, meaning that whenever price comes and tests this area, it's forming what we call what we call the bearish differential. Whenever price comes and tests that area, it forms what we call the bearish differential. Bearish differential. Bearish differential. Bearish. Okay. Reason price needs to come and consume the liquidities that are left inside this here. But when the price performs a pure bearish, that's when the price comes and tests that validation point or the validation level. It means that all the liquidities that are inside that area may be consumed from the lower time. So we can't see liquidities consumed on higher time frame, but we see liquidities being consumed on lower time frame. Okay, on lower time frame. So when price performs a pure bullish, a pure bearish, price has no liquidities that should be consumed inside this area. So price tends to perform what we call a pure bearish. Okay, so sometimes also it does the opposite of the other. Price performing a pure bearish may be a reason. So price performing a pure bearish may be a reason of an area of liquidity that's left here. Because whenever price leaves this area of liquidity, price tends to get the momentum to push it up. So price may shift there, leaves us an area of liquidity. Whenever price performs a pure bearish, it means that price may be targeting this area of liquidity to get the momentum to push it up at here, to come and consume the liquidities that are left inside that zone before it continues down to perform what we call a pure bearish. Okay, a bullish different bearish. And sometimes the price may leave any formations that are left here, and price come to test the last liquidity engineering that is happening. We should always be able to look at our eyes, that we can definitely understand how price moves. Okay, so that's what a bearish trend is always doing. So whenever we are seeing a bearish trend, our main aim is to buy the market, is to sell the market. Our main aim is to sell the market, but definitely we can also take buys according, but sometimes taking the buys from these areas is a bit risky because we don't know sometimes when price is going to go back or to go. Okay, so that's how we do a bearish trend. So if you're marking the bearish trend, always mark the lows that participated to break. So this is a break. This is a break market structure. Never price close this performs a break market structure. Okay, so this becomes a break. So let's assume now this is our bearish scenario. Price performed a break on market structure. I told you should only wait for price to perform a structural confirmation with a candle closure. Whenever price closes with no candle closure, it means that it has performed a structural formation. So it performs, it closes something like this. It closes something like that. It performs what we call a pure, or it performs what we call a structural formation. But when it does like this, it forms what we call a structure of formation. You know now the buyers or the sales are strong. So you know now price is going to come and participate or retest on the area that has the low that participated to a break. So this is the area that has the low, the high that participated to the break. This is the high that participated to the break. The reason the momentum of sellers that broke this came from this area. Momentum of sellers that broke this low to form a break market structure. To form a break market structure came from this. So remember, we had the buyers coming in here. So sellers came in. So buyers tried to come push it back, but unfortunately, the momentum of sellers came from this low and then pushed price lower. So whenever we get a candle closure here, we know now this is the low, this is the high that participated today. That is the area that price must sometimes come to the retest and then finally continue moving down. So you can get the C price would have come and tested that area there like this, and then continues moving up because it needs to consume or to rebalance. The reason why price tends to come to go and test those areas is the reason that price is a must that price must balance the market in between the buyers and the sellers. It's a matter of price balance the market in between the buyers and the sellers. So we have two formations here. We have this one and this one. So we always have to mark the high that participated with the break, because now this way the momentum, because you had the buyers coming in, sellers came in, buyers came in, sellers came in, so buyers came in with the out. So it means that the buyers, it was a battle in between the buyers and the sellers here. Okay, it was a battle in between the buyers and the sellers, but look at the buyers, we are left after the sellers having a lot of momentum. After the sellers having a lot of momentum. So whenever we confirm a candle closure here, or the structural confirmation here, when our price is going to come and retest the area that had the momentum. The area that had the momentum, or the high or the low that had the momentum. So we mark this as our new area of liquidity. So price has to come and retest that area before it should have continued moving down. Okay, that's how the market works. So we always move in a series of forming lower highs. These are the lower highs because they are upper, and these are the lower lows because they are lower. So the other thing that we should also talk about in uptrend, we only need to see a break of market structure on lower lows. So break of market structure should always form on lower lows. But we don't want to see price breaking any of these lower highs. If price breaks any of those lower highs, it means that price may shift or may go to another direction. Means that we should have a series of lower highs dropping like this. We should have a series of lower highs breaking like that. You not need to see price breaking maybe this line. It's called well, my illustration is bad, but you don't need to see lower highs breaking each other unless let me show you. Unless we have something like this. Unless we have something like this. Unless we have something like this. So now we know now this is our validation point, and this is our invalidation point. So unless price performs what we call a structural formation on this area here, price shouldn't break these lower highs, should not with the candle closure, but with the wick it's okay. So sometimes price may come to close with that, with a weak point here. Wait a bit. Whenever price is closed with a week on that invalidation point, we are still safe because with the momentum, or it was just a week, meaning that our sellers are still in control of the market. But whenever price closes with the candle closure, it means that now we should look for sales. We should now start looking for. We should now start looking for buys. Okay, now start looking for buys. So whenever price closes with the week, we are still safe. Now, the other thing to talk about the trend is only found on 2 or situation time frames. The trend is found on the daily 4 hour, 1 hour, and maybe 30 minutes. 30 minutes. Minute. Anything below that is a total confusion. Anything below that is a total confusion. So it means that on a weekly and the monthly time frame, we don't have a trend there. And monthly, it's not trend found on weekly and monthly time frame. There's no, because now this is where I find direction bias, which is going to be our next topic. Meaning that the reason why we say that trend is only found on the daily time frame and 1 hour and this time frame, because we have a lot of trends. Reason, you may be having a very scenario like this. So let's assume now this is the daily time frame. You have this, you see this leg. Let me make this color another color. You see this leg that is dropping. It's having a trend, which is the lower highs and the lower lows when you go now to 1 hour time frame. That one candle there, you may see price having lower highs and lower lows, lower highs, lower highs, lower highs and lower lows, lower highs and lower lows in that one candle. Because now we are on a day time frame, we have seen price dropping lower, forming a downtrend. But on that one candle here, or that one bearish candle here on a day time frame, when you go to the 1 hour, you're also having what we call a trend. Okay, even on this leg here, okay, you may be having one candle, just assume you may be having one candle here on that leg, but on that one candle, you're also having a trend on 1 hour, which is the one that is having highs and lows, highs and lows, highs and lows, meaning on that one, on this one leg on 1 hour, on this one leg that is moving, you also have something like this on a lower time frame of 15 minutes. That's meaning that we have a lot of confusion. So I only trust the trend I find on these these time frames. Okay, remember, a market out the trend is always chasing the direction bias, which is going to be our next topic, the direction bias. Okay, so the trend is only found on a daily time frame, at the 4 hour time frame, the 1 hour time frame, the 30-minute and the 15-minute. That's where we're finding trend. And even if 15 minutes shouldn't be there, but according to some reason, it should be added. Remember, if this is a bullish trend on the 4 hour, you see only this trend may be having 1,000 trends. Only this trend, or only this leg may be having 1,000 trends. How? Only this leg may even see, let me show you. You may be having like 2 candles here. May be having 2 candles there. Okay, maybe having 2 candles, but each candle may be having 50 trends. How? So this is a daily time frame. This is a 4 hour time. So one candle may be having something like this. One candle may be having something like that. One candle may be having something like that. This one candle, you see, this one candle is having this trend. This one candle. So inside that one candle also, we have this. We have this. So inside this, oh sorry. Now inside this leg, this one leg here, this one is that one leg. We also have something like this inside that one. Okay. So that's why I tell you that you only find the trend on the situation time to the daily and the others, but on the weekly we don't have a trend. We only have the direction. But even on this leg here, even on that leg here, we're also having a downtrend like this one. Okay? And in that downtrend, we also have, in this downtrend that you're seeing here, we also have something like this on a certain leg. Okay, so that's how the trend looks like. So we shouldn't get confused. That's why I don't prefer using tool. So unaweza kutaja PC. So unaweza kutaja PC. Hii unaweza kutaja PC. So on this second candle, you may also be having this bullish trend. You may be having that bullish trend. On this second candle, we have that bullish trend. On that bullish trend, you may also be having a bearish trend. So it's a lot of confusion. So in my conclusion,
you can day trade with this.
Is that the trend is on your, how the trend is found on a daily and 4 hour. Okay, that's where we find the trend of the market. The daily and the 4 hour is where we find the trend of the market. Anything below this is not a trend, is a total confusion. Maybe we can also add 1 hour, maybe, but we only find the trend in the daily and the 4 hour. So we only confirm a trend by going to anything that do coordinate with these time frames. Okay, we confirm the trend by going to 1 hour here, and confirm a trend by going to the 30-minute here. Are we together?
One question.
Yeah.
Yes. Does that mean from 1 hour you can take an entry from 1 hour and 30 minutes?
Why do you explain that when you're coming to the action bias on our next topic? Because we're almost less than 1 minute. So, but this is what you should understand. So these are the situation 2 times.